All right, hey everyone, good afternoon. It is 2:30 Friday afternoon here. The markets are closed and the first week of the trading year is done. So let's just jump right in and talk about what we're seeing and what's happening. So this is soybeans, November 24 contract. So what's going on in this market? I think that there's a couple things, right? Number one, you have some moisture hopes in South America. So that crop, some people say it's big, some people say it's small, and bottom line is the trade is just trying to digest it and understand what how many bushels we're dealing with from our friends in the South. And I think also weighing on our market is the rotation from corn to beans that's happening here. As you know, we've talked extensively about this on our corn balance sheet. That if we post a 95 million acres at a 184, that crop is so big, our carryout swells pretty radically to above 3 billion bushels. And so the market's job is to not let that happen, and so we're going to shift acres over to beans. And if that shift does happen and we have a big crop in South America, then our bean carryout is going to grow and swell, and we're going to move into a full oversupply situation. So the argument or the catalyst for lower prices is very real, and it's present because there's just no other way to look at it, that our carryout is going to grow, and you have to get cheaper to stimulate demand to get someone to buy all of that carryout. So that's kind of the big picture of what's going on in corn and beans. There is a lack of bullish catalyst, other than maybe the funds are too short or the seasonality should be turning. There just seems to be a lack of interest in buying, and so and with until somebody steps in and starts buying, like China buys 5 or 10 million metric tons of corn for 2 or 3 days in a row, all of a sudden now you have a different story, but that catalyst doesn't exist yet today. So that's why we're just kind of grinding lower and lower and lower. So technically, what are we looking at? Well, this should jump out at you on the screen is this gap right here that happened on Tuesday. And the fact that it has not been filled is not a good situation. So this means that this is either a breakaway gap or it is a measuring gap. If it's measuring, measures from here, which is 1317, down to here, 1244. So, and then you would just double the distance. And where does that count to? So 1317 to 1244 is 55, basically 70 cents. And 70 cents from 1238 would take us all the way down to about 1170, which is right down here into this Fibonacci zone, right in this area here. So what's our downside target? This is our first downside target. If these fail down here, then our next one is all the way down into the low 11s, and that is a risk. Do I think we go straight there? No, but it can. And so we have been hoping for the last couple days that we'd get a little bit of a bounce, and I still think we might get that, particularly when we look at the wheat market and we look at just kind of the chart structure there. But keep it simple. You got a breakaway gap or a measuring gap. You've got in that gap this significant area of support right here. So lower you have to look. So I think it's prudent to move into probably hedges, certainly on any kind of a bounce. I think we're going to want to sell it unless there's a catalyst and a reason not to force us to sell it, because then we can just always put calls on, and then if we get up above all this stuff up here, then we'll have to readjust that thinking. But as long as we're below here and we kind of stay below all this stuff, then a downward bias has to be where you're thinking. All right, now let's jump to March corn. March corn does not look great. We opened Tuesday lower, and we just kind of have consolidated and ground over on the bottom side of this range. We've finally broken out of this area here. So for a lot of people that have been with us for a while, we are in short $5 calls, long 480 puts. We're looking for a reason at some point in order to drop those puts down or make some adjustments there, but we haven't gotten that reason yet. And again, it's same thing we just said. There's just no catalyst. So without a catalyst, you get this grinding lower trade action. So there's not any reason to put reownership on at the moment. There's not any reason to do anything with old crop corn. New crop corn is a little bit of a different story, I think, even though we are just now starting to break down below the support levels. We're short futures here with long calls, and the question is when do we want to take those calls off? And I think we're probably really, really close. I'm a little hesitant to take them off right now just because we do have a crop report coming up. But maybe that's not the right way to think about it. Maybe we should just take them off and keep that downside protection really maximized so that those hedges pay off. But for now, you're covered. We're just losing a little bit of time premium up here on the calls, but our short futures are making up for that. So nothing super bullish on this chart at all. Support's not holding. Any kind of a rally gets smacked with selling, and so it's just a lower grind, and it's going to stay that way until it has a reason to change. Okay, March Kansas City wheat. This looked really, really good early in the day. We did fall off and leave a long upper shadow, but we didn't reverse it. Through this whole consolidation period, there have been lots and lots of days and weeks where it's like every single day is a reversal pattern. You reversal to the downside, then the next day you're back up, and you just continuously seesaw and just chop people up like crazy, going through that. And today was one of the first days that we have had a little bit of follow through, but it still ended up weaker than maybe what it should have, and I think that's spilling over from corn weakness. If there's an opportunity for corn to go higher, it's if wheat is able to break the 650 level and push itself to come challenge these upper levels up here. Is that possible? Yeah, absolutely. I mean, look at these divergences that have happened all the way back since October. They're still in play. They're still in effect, and this market has not worked off that deep oversold condition here, and there is a chance that this thing could pop pretty quickly. Wheat, if you follow wheat, when it moves, it can move really, really explosively, and it can do it without any really good reason. But here we are into coming into the weather season. Wheat has been declining for the last couple of years. We've been using more than we're growing. The issues in the Black Sea aren't done, even though nobody's talking about it. They're still there. And so I think wheat has the potential to be dynamic, but obviously it hasn't done it yet. If a catalyst were to come, I think it could heat up really quickly. So we want to make sure we are ready and able to participate there. But for now, no action really necessary until or unless you wanted to take a shot at the long side. There's a risk right down to this level here, which is pretty low risk, nice reward if we think we are going to be able to challenge the higher levels here. Okay, where are we in relationship to history? Here is a spread of Kansas City wheat minus corn, and I just want to show you where this is. This goes. This is a monthly chart, and I'm going to take it all the way back to 1980. Comes all the way back in here. Where are we? We are dead center in the range. So the grain complex has kind of reverted itself to its means, and we're kind of deflating it. So wheat is expensive relative to corn now, which means we're feeding corn, not wheat. And remember, when corn started to get scarce, wheat collapsed relative to corn and inserted itself into the feed ration, and then the Black Sea happened, and we had to take that and get it, and it became scarce again, so we had to push it to almost record highs. Now we've unwound that and put it right back to mid-range. I'm not showing you this because we have any bias on it. It's just where it is. So I don't think we have a lot of reason to think that this spread is going to change, which tells me that wheat and corn are probably going to move together. And that's the point of this whole analysis, is that they're probably not going to be too different from a general trend for very long. They can go different ways for a few days, but generally they're going to come back and kind of move to the same direction at the same time. And then beans are the ones that are going to have to just kind of tag along with it. So what are we doing from a risk management standpoint? Nothing. We're already hedged. We're in good positions, especially with old crop. With new crop, we're really well hedged corn. We're under hedged in soybeans, but we've got a lot of time left before we really need to do anything. But if we want to be careful and make sure that we do protect our downside risk, selling beans with a re-ownership strategy back above 1251 is definitely a plausible plan. Okay, that is what we've got for you. We'll be back with you Monday. Remember, there is always risk trading futures and options, and you should only do so in light of your own financial condition. If you have questions, please reach out and talk to us. We're happy to talk through any positions that you're in to help explain those, or just happy to give you a little bit more color and perspective on the market. Hope you guys have a great weekend. We'll talk to you Monday. See ya.